People have all sorts of theories about effective debt management. On one hand, some say that if you can't pay in cash, you can't afford it. Others put everything on credit, like it's a fairy godmother magically paying for things. Now that you're adulting on your own, you've probably realized that credit isn't magic, but it is absolutely essential when it comes to buying a castle of your own. The problem is, poor debt management can leave you with nothing but pumpkins and mice. If that sounds familiar, don't worry, you're not the only one. One of the biggest credit-related questions people ask is whether paying a loan off early hurts their credit. That's what we're going to talk about in today's video. How you can work toward your financial goals without the fairy dust and squishy garden vegetables. The answer to the question of the hour is, yes, sometimes paying off a loan early can hurt your credit. Credit utilization refers to the amount of your available credit expressed as a percentage. If a credit card has a limit of $5,000 and you have a $3,000 balance, your credit utilization on that card would be 60%. This element of your credit is given a significant weight in your credit calculations. Almost a third of your credit is based on utilization. Many experts agree that a credit utilization rate over 30% could negatively impact your score. But is there such a thing as utilization that's too low? Turns out there is. Some financial experts recommend that you keep your credit utilization between 7 to 10% for maximized benefit to your credit. Basically, you have to use your credit to build it. A 0% utilization rate won't cut it. Use the 7 to 10% figure to calculate the ideal rolling balance for each card, and don't try to undercut it. You could also decide to keep some cards at a $0 balance, and others with a little more, since utilization is an average across all accounts. Strategize based on interest rates, fees, and rewards to decide which cards to leave at zero and which ones to use at a slightly higher balance. Whatever you do, don't cancel the cards you pay off. Keep the accounts open, just don't use them. If you close them, your credit utilization numbers will take a hit. Now you might be wondering, what about my mortgage or car, student and personal loans? What happens if I pay those off early? These kinds of loans are not factored into the credit utilization category, but they do impact your credit diversity and age. Unlike paying off a credit card, paying off an installment loan closes the account, so your portfolio of debt no longer contains that loan, and you lose diversity. Paying off an installment loan also lowers the overall age of your accounts. If you pay off a loan too soon, the account can't build future credit. If you pay off a loan that's significantly older than the rest of your accounts, you could see a hit then too. If you really want to reduce interest or length of the loan, often lenders will allow you to pay extra each month to the principal. It'll depend on the loan and the lender, but if this is available to you, it's a good compromise. That said, there are cases in which it could help to knock out some loans. As mentioned before, your credit will benefit greatly from paying off revolving credit to get your utilization down. Depending on how high your credit utilization is already, this might seem overwhelming. Some experts recommend starting with your highest interest card when paying off revolving credit. Others suggest starting with your lowest balance card. One is not necessarily better or faster than the other, but each has its advantages depending on your financial goals. This type of debt is where you can usually count on raising your credit by paying it off. When it comes to installment loans, there are fewer cases in which paying them off early will help your credit. However, some examples of neutral outcomes include paying off installment loans closer to the end of the term or shortly before taking on another similar loan. One potential scenario in which paying a loan off early would benefit your credit indirectly is if you have negative payment history with that creditor. The history itself won't go away after it's paid off, but you can avoid making it worse in the future and give it a chance to age off your credit. Additionally, regardless of how they hurt or help your credit, there are some loans that are worth paying off ASAP. For example, the negative impact of keeping predatory or high interest loans active likely outweighs any benefit to your credit. Finally, improving your credit doesn't have to be a solo task. Hiring a credit repair company like creditrepair.com is an additional tool when conquering credit issues. They'll hook you up with a free credit report summary and evaluation, including a summary of any negative items that are hurting your reports. Now that's our kind of fairy godmother. It's important to understand the pros and cons of paying off loans early. Putting your money in the right places at the right time is a good way to avoid relying too much on sparkly credit, destined to turn rotten if not handled in the right time frame. If you're interested in starting your credit repair journey, head over to creditrepair.com today. Be sure to check out the full credit repair tips playlist in the video description and leave us a comment below. Your feedback helps make this channel better.